Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets corporations try to hide in their filings. Today we're diving into FMC Corporation's latest report, and let's just say it has got some interesting twists and turns like a financial telenovela. Before we jump in, if you love getting the real story behind the corporate jargon, make sure you are subscribed. And for more in-depth discussions and to connect with fellow finance enthusiasts, join our Discord community, linked in the description below. Alright, FMC Corporation, this is a current report, meaning something significant just happened. They filed an 8K, which is like a company's urgent bulletin to the world. And the earliest event reported is the 8th of December 2025. So, what is the big news? FMC has made some pretty significant changes to their main loan agreement. Think of it as updating the terms of a massive credit card to give the company more flexibility. This isn't just a small tweak, it is amendment number 5 to their 5th amended and restated credit agreement. That is a mouthful, but it essentially means they've been adjusting this deal quite a bit over time. The main reason for this amendment is to adjust what are called financial covenants. These are basically rules that the company has to follow to prove they're financially healthy enough to keep borrowing money. Two key ones they've tweaked are the leverage ratio and the minimum interest coverage ratio. Think of the leverage ratio like this. It measures how much debt a company has compared to its earning power. A lower ratio is generally better, meaning the company isn't borrowing too much. The interest coverage ratio is about whether the company can actually afford to pay the interest on its existing debts from its operating profits. Keeping these ratios within certain limits is crucial for avoiding trouble with lenders. Now, the really interesting part is that they've extended what is called a covenant relief period. This means they've been given a bit more breathing room on those financial rules, possibly until the end of 2028. This suggests that they might be anticipating some financial challenges or want to undertake significant projects that could temporarily strain these metrics. They've also put a cap on how much debt their subsidiary companies can take on, limiting it to $350 million. This is a way to control risk within the larger organization. And then there is the dividend. They've put a restriction on dividend payouts. Specifically, they can only increase their regular quarterly dividend above 8 cents. Per S-hair if their leverage ratio is below a certain point, 3.75 to 1. This tells us that if the company's debt levels get too high, shareholders might not see dividend increases. It prioritizes debt management over immediate shareholder payouts. Another notable change relates to intellectual property. The company must ensure that certain intellectual property assets are worth at least $1 billion. This is interesting because it shows they're valuing their innovations as a core asset and a financial backstop. And here's a big one. If their credit rating from major agencies like S&P, Fitch, or Moody's drops below specific thresholds, the company will essentially pledge almost all of its assets as collateral for the loan. This is a significant signal about the potential downside risk and how serious lenders are about their money. It's like saying, if our financial health really tanks, the lenders get dibs on pretty much everything. All this information from item 1.01 is also being incorporated into item 2.03, which deals with the creation of direct financial obligations or off-balance sheet arrangements. Essentially, it's confirming that these loan agreement changes are creating new financial commitments and obligations for FMC Corporation. And finally, as is standard for these reports, they list out the exhibits. The most important one here is Exhibit 10.1, which is the full amendment number 5 itself. That's where all the nitty-gritty details are. They also included Exhibit 104, the interactive data file, so analysts can easily crunch the numbers. So, what does all this mean for FMC Corporation? It looks like they're proactively managing their financial flexibility, possibly preparing for strategic moves or navigating a challenging economic climate by securing more breathing room on their debt obligations. The extended covenant relief period, the dividend restrictions, and the pledge of assets all indicate a company that is very focused on maintaining its financial stability and access to capital, even if it means imposing some internal financial discipline and potentially signaling some underlying risk to investors. It is a balancing act between growth opportunities and financial prudence. Now, let's look at the bigger picture. FMC Corporation is a major player in the agricultural sciences industry, focusing on crop protection chemicals. In today's market, their business is very sensitive to global agricultural trends, weather patterns, and of course, commodity prices. Companies like this often have to manage very large research and development budgets, significant manufacturing operations, and operate in a highly regulated environment. The decisions reflected in this filing about debt and dividends are critical for how they fund their operations, invest in new products, and return value to shareholders. Looking at this filing, the key takeaway is that FMC is actively restructuring its debt agreements to gain financial flexibility. This is not necessarily a bad thing. Companies often do this to be better positioned for future investments or to weather potential downturns. However, the specific terms, like the asset pledge upon a credit rating downgrade, do highlight a level of sensitivity to their financial health. The dividend cap also suggests a management prioritizing financial stability over immediate shareholder returns, which can be a sign of prudence or a sign that they anticipate needing cash for other purposes. It is a strategic maneuver that signals a company trying to proactively manage its financial risks and opportunities. Overall, FMC seems to be taking a cautious but strategic approach to its financial management. They are adapting their loan terms to give themselves more room to maneuver. The success of these strategies will depend heavily on the broader agricultural market and their ability to continue innovating and executing their business plans effectively. Alright, that is our breakdown of FMC's latest filing. What is your take on these financial maneuvers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more great conversations. Thanks for watching, see you next time.